Okay, this is 82. Pangli company, a very important question. It's about your cash operating cycle. If you read the requirement, very important question. It says that calculate the cash operating cycle of Pangli company at the start of January 2007. You know, the things, the concepts which you are going to learn in this question, you will be actively using this knowledge in your exam. So please do this question very carefully. Very interesting, very important question. Let's start reading it together. We'll spend some time on reading. It's important. It says that it is the middle of December 2006 and Pangli company is looking at working capital management for January 2007. So you are planning your next month. Forecast financial information at the start of January 2007 as follows. So you believe that in the beginning, like on 1st of January 2007, your inventories will be $455,000. Receivables would be $408,350. Payables 186. Overdraft will be 240,000. So this is our opening position of working capital. Okay, receivable, payable, and cash, and whatever inventories. So either you have cash or you have overdraft. You don't have cash, you already are into negative. Overdraft means you are in negative cash. So all sales are on credit. All sales are on credit, and they are expected to be 3.5 million for 2006. So the current year, not 2007, but 2006. Current year sales are 3.5 million. Monthly sales are as follows. So this is your November, December. This is actual sale for November because it is already it has already occurred. December are forecast sales because you are sitting in the middle of December. So this number is a forecast, 300,000. Then January sales next year, it is also forecast number, 350,000. And these all are on credit. Now, what are the terms of payment? How do our customers, they pay us? Let's see. Pangli company has a gross profit margin of 40%. So with the help of this 40%, we can find out our cost of sale, okay? So why do they give us 40%? Like this is my sales, and if margin, it is margin 40%, 60% of this will be your cost of sale, because you need to calculate, you need to use cost of sale in many different formulas. So with the help of this 40%, you can calculate remaining 60% will be your cost of sale in these periods. Although Pangli can offers 30 days credit, only 60% of customers pay in the month following purchases, while remaining customers take an additional month of credit, which means that whatever you sell, this 300,000, some part of that will come in January. So 60% will pay in the next month, and 40 will pay even in further another month. Customers pay in the month following the purchases. For you, these are sales. For customer, these are purchases. So your sales following the sales month. Inventory is expected to increase by 50 to 250. So your opening inventory is 45. Closing inventory will be 455,000 plus 52,000. Pangli company plans to pay 70% of trade payables. So from here, we can calculate our purchases, and those purchases will be our payables. 70% of payables in January 2007, and defer paying the remaining 30% until the end of the February. So only 70% you want to pay, 30% you will pay in February. All suppliers of the company require payment within 30 days. Credit purchases from suppliers during January 2007 are expected to be 250,000. Okay, so this is done. It's a very interesting scenario, a very real life looking scenario. Interest of 70,000 is due to be paid in January. This is cash out interest on fixed rate bank debt. Operating cash outflows are expected to be 146,500. These are your salaries and other operating expenses which you have to pay. Pangli company has no cash, mashallah, and relies on its overdraft to finance daily operations. So there is no cash available. Of course, we can see that they are in overdraft. And if there is any cash deficit, they will take further overdraft. So overdraft may increase if there is a need. Um, the company has no plans to raise long-term finance during January 2007. Assume that your each year is 360 days. It is very important. In many times in F9, they say 360 days. Sometimes they say 365 days. If they do not speak anything about the number of days, by default, you should always take 365. But in this case, they have told us 360, so we will assume 360. Question number 1, only for 2 marks, calculate the cash operating cycle of Pangli company. Now, we know that cash operating cycle, it consists of, so let's do it like this. Your first part is, what do you call this number? A1. So I'll call it A-1, okay? A1. You have to calculate your cash operating cycle. And cash operating cycle is actually, it is equal to your, raw material days, which you call inventory days, then plus your production days, then plus your finished goods days, and plus your receivable days, and minus your payable days. So this is generally a long formula considering all these things. But in our case, we do not know all of them, okay? We do not have all of these things. We can only add your inventory days, receivable days. We don't have production days. We don't have finished good days. So in our case, we can say that our inventory days plus receivable days and minus the payable days. I mean, for us, it is like this, okay? Because other information is not available. So for us, this is going to be our cash operating cycle. So first we need to calculate our inventory days. And we know the formula for inventory days. The formula for inventory days will be how much is your inventory and then how much are your purchases, and you do it with multiply it with 360. So first we need to find out how much is our inventory. So inventory days are, it depends on your cost of sales and inventory. So let's first calculate our cost of sales. Cost of sales is your, so they told us that our profit margin.
It is 2.1 million.
Yeah, no, profit margin is, I think, 40%.
60%.
And therefore cost of sale will be 60%. So I can say that my cost of sale is equal to, cost of sale will be your 3.5 million is your total revenue, 3.5 million, and 3.5 million multiplied by, because I'm assuming 3 zeros on the top, 0. Into 60%. Into 60%. So we get here. We get 2.1. So 2.1 million is our inventory. They are actually, in this particular question, the numbers are not in millions, okay? Usually when you have big numbers in millions, we start putting 3 zeros on the top. Your numbers are already in 100,000s. If you want, you can use 100,000 format as well. If you don't have millions to deal with, you can only this one number is in million. All other numbers are in 100,000. If you feel comfortable, you can use like this as well. It makes no difference. It is 2.1 million, you call it. I mean, you can use any format, doesn't make any difference. So inventory days will be, now you've got your cost of sales. This number we are going to use, and inventory days are, how to say, 455,000 divided by 2.1 million multiplied by 360, because our 1 year is 360 days. So we've got answer 78. This is 78 days actually. Similarly, you need to calculate your receivable days, and you should not forget that receivable days you should be calculating on sales. your sales figure is 3.5 million. Inventory days you calculate on cost of sales, but receivables, they are about sales. So receivables you should be doing, your receivables are 408,350 divided by 3.5 million. Okay. Here you don't maltreat cost of sale. It will be done with the sales volume because receivables are coming from sales. So we put it here and it is 42 point something. I call it my receivable days. These are also days. And then we have our payable days. And payable days, you will take your payables, which are 186,700, divided with cost of sale. This will be done with cost of sales because payable are from purchases, and purchases is your cost of sales thing. And you got 32 days here. Okay. So this is also your days. And now what you need to do, your cash operating cycle is actually 78 plus 42 minus 32. And you put it here and let's put equals to sign. It is 88 days. So 88 days is your cash operating cycle, which means that you have to finance your activities. You have to finance your operations for 88 days. So this is for just 2 marks. Next is, it says that calculate the cash operating cycle of Pangli company at the start of January 2007. So this was at the start of January 2007, beginning of 2007, which means ending of 2006. And this is the reason we took this information from the beginning of, it was start of 2007. End of 2007 or end of January 2007, we are not doing. We took these numbers because these numbers are coming from beginning of 2007, which means the last day of 2006. So we took these numbers. So this part 1 is done. Part 2, it says that A2, I call it A2 like this. A2, it says, calculate the overdraft expected at the end of January 2007. Now, this is important. How much overdraft do you need at the end of January 2007? Here you need to see that how much money you will receive from customers, how much you will pay to your suppliers, how much you will pay to you for your other expenses, how much overdraft interest you will pay, and how much inventories you will increase. All of these together we will calculate and we'll say this is what is our cash shortage and this is what we need in the overdraft. Let me say, let's talk about first what is our, that we have to calculate our overdraft, and overdraft will depend on how much receivables you have, how much payables you have, etc. Okay, so let's first calculate our receivables. At the end of January 2007. Okay, this is we need to calculate how much will be our receivables at the end of January 2007. So it will start with your opening receivables. So how much are the opening receivables? Your opening receivables are given as 408,350. And then your customers paid, you should say cash received from customers. So how much cash are you receiving from customers? Your customers are paying you from the previous months. If you see the policy, it says that
50%.
although
50%.
Pangli company offers 30 days credit, only 60% of the customers pay in the month following the purchase, while remaining customers take an additional month of credit. So it means that I am selling goods in January. They will not pay me anything, okay? But this was sold in December. Some part of this will come in January. And this is November. Some part of this will come in November, in January. So November sales, you will receive something in January. And December sales, you will receive something in January. So how much they give, it says that 60% pay in the month following the purchase, which means the next month. So from December, if I say that December sales, 60% come in January. And I would say November sales, 40% come in January. January sales, you will not receive money. The goods which you sold in January, those customers will not pay. They will pay somewhere in February or March. Let's make it a little bit like this. Okay, I just create some space. So how much are my November sales? November sales were 270, 875, and December sales. December sales are 300,000. So 300,000 multiplied by 60%. This comes. November sales were 270, 875 multiplied by 40%. These two numbers you will receive in the month of January. So take it here, put equals to sign, and multiply with -1 because this will be reduced. So this is your opening receivable at the beginning of January. This much money you will receive from customers, and this you will also receive from your customers. Plus you will have January 2000 sales, all on credit. These January 2000 sales will be on credit, and how much they are? They are 350,000. So when you make a total of these numbers, you get an answer 470,000. So it means that your expected receivable balance, your expected receivable balance is $470,000. So, I mean, not very difficult, but this is one skill which you need to know how to calculate. My opening receivable minus the cash coming in from the December sales, minus the cash coming in, because this includes November, December sales, okay? It includes November, December, and the previous months. So this will come in, this will come in, this I will sold new, I will sell new, and this is my receivable balance, which is 470,000. Now, similarly, you should be calculating your payables. Listen, I have to calculate my overdraft requirement, and my overdraft requirement will need my this calculation. Now I need to do my payable balances. Okay, so let me drag it down a little bit. Please allow me. And I drag down a bit more. And we have to calculate our payable. Now, based on this, you can start doing it the same way. That how much do you have the payables at the beginning? You would say that opening payables at the beginning of January 2007, opening payables were 186,700. So this was given 186,700. Then you have to make some payments. How much payments are you making? So you have opening payables of 186,700, and they tell you in question that Pangli company plans to pay 70% of the trade payables in January 2007. So whatever are your opening payables, 186,700, 70% of this you want to pay. So we say that
70% of December?
payment to suppliers. No, not from December, whatever you have. Whatever you have 186,700. This is your payable in the beginning of January, on 1st January, and you want to pay 70% of this. So this will decrease your payable. So I will multiply it with -1. So I say that I had my opening payable 186. Out of this 136.90 I will pay, but then you will also make some purchases, credit purchases during January, because you will definitely make some purchases in January. So how much purchases you will make in January? So January forecast purchases are how much? Can somebody tell me this number? So credit purchases during January, yeah, it is given here. It says that it will be 250,000. So this is, I would say, as per question, that this information you took from the question, 250,000. So this is going to be your payable balance. So you will have your receivables, you will have your payables, and I put it here. So payable balance at the end of the period is 360. My receivables will be 470,000. And then we need to calculate our, how to say, overdraft thing. So overdraft will be pretty much simple. Would say that overdraft facility. And how much will be the overdraft facility? You would say that your opening balance. How much is your opening overdraft balance? It is given in the question that you have overdraft existing opening balance 240, 250. So you have 240,000, 250. 240, 250 is the opening balance of overdraft. Then you will say that payments to suppliers, and which payment you make to supplier, you will make this payment to supplier multiplied by -1. So this is my already existing overdraft, plus I need to pay to my suppliers. So overdraft facility will further increase. Then you have to, payment for operating expenses. It will further increase your overdraft facility, which is, I think, 146,500. Then you have to pay the interest payment. Interest payment is how much? I think it was given somewhere here. Interest payments are, there is an overdraft interest. We need to pay 70,000. Interest of 70,000 is due to be paid in January. Here we go. So this is also something we need to pay. So 70,000 we need to pay. So this is already my overdraft. Then this payment further I make, this I make, this I make, and then you cash received from customer. From customers. So how much cash we are getting from customers? We are getting these two amounts, 180,000 plus 108,350. These two amounts we are receiving from customers. So this is cash coming in. And this cash coming in will decrease your overdraft because you got this cash, and you make a total and you get 299,090. So this is your overdraft facility at the end of January 2007. This number we needed. Any question you want to ask until here, please? Listen, if you want to ask me, actually all of these are negative. This is actually minus 240. This payment is also, minus number because I'm paying. This number is also minus because I am paying. This 70,000 is also minus because I'm paying. And this number is actually a positive number. So you can do like this, you can do the other way. It makes no difference. This is cash coming in. These are cash going out, and this is already my negative balance. So you show it in this way or you show that way, it doesn't make any difference. But this is the cash only item. The cash coming in is only this one. All others are your cash payments. And your overdraft balance, 299,090.
Yes.
Together. So next part, it says that A3, calculate A-3, it says that calculate the current ratio at the beginning and end of January 2007. Okay, pretty simple. It's not, should not be difficult. You should say that here you have, let me call it 010107, and I can call this one as 310107. So beginning of January and end of January. And we know that current ratio means current assets divided by current liabilities. So your current assets in this case are only your current assets are inventory and your receivables, and your current liabilities are your payables and your overdraft. So these are the numbers which we need to put in. So current receivables, current assets I've got, and current liabilities I've got. And these numbers are there. We just need to put them into place. For example, how much was the inventory at the beginning? They told us that inventory at the beginning is 455,000 and receivables are 408,350. So let me just drag down so that we can work comfortably. And current assets, I will take inventory at the beginning was 455,000 and receivables are 408,350. You make a total of these two numbers. This is your opening current assets. And how much were the opening liabilities? Your payables at the beginning 186,700 and overdraft was 240, 250. And you make a total of these two numbers and you get this number here. So we have got this, we have this, and we can say that current ratio, I would say that, current assets divided by current liabilities. And this will be 866 divided by 426. It is 2.022. Just make it in two decimal places. This is your ratio here at the beginning of the month. And how much do you have at the end of the month? End of the month, how much would be your inventory and how much will be your receivable and payable? So they said that inventory is planned to increase by 52,500. If you remember that we are increasing the inventory. So what we can do, that inventory we are increasing by this number. So it would be this one plus 52,250. We got the number 507 will be your inventory. Your receivables, we just calculated here. Receivables are 470,000. So let me just take it from here, 470,000. So my receivables, my current assets at the end of the period are, 977 current assets. If I talk about liabilities, payables we calculated was 306. This is your payable at the end of the period. And overdraft, how much will be? Overdraft will be this number, and let's put it into -1 so that we get a positive number. We can add them. And this is your now current liabilities. And then you just control C and we put it here. Your current ratio has decreased a lot. Your liquidity position is not really good. Liquidity position is not really good. Current ratio has significantly fallen down. So this is, we understand the situation, what is happening. Because why this is being done, because customers are not paying in time and you had to increase your, how to say, payables. You are also increasing your inventories. You're also increasing your overdraft. Customers' receivables have also increased by significantly. Anyways, it says that the next part, 10-mark question, that's very important, 10 mark. Discuss 5 techniques that Pangli Co. Could use in managing trade receivables. There could be many, many, many different techniques for receivables, but you have to mention 5 only. And there are 10 marks, so it means that they are going to give, 2 marks for each technique. You can start with the one general idea, 2-3 lines as the introduction. What you make, that how the receivables are managed. You could say that working capital, managing the trade receivable is one part of managing your working capital. And we know that management of working capital is crucial of smooth running to a business, and within managing of working capital, trade receivables, they play an important role. So when businesses, they do agree to give credit to their customers, because giving credit is important, is vital to realize the sales, and therefore credit must be given. But when you give credit, there are certain things which a business can follow, or which a business can pay attention to, starting with whom to give credit. So you do credit assessment, and how much credit you should give, and the signing of the contracts and the terms and conditions of payment, those should be very clear while making the credit sales. So this is like assessment and credit worthiness. You always start with the receivable management. Whenever you get a question about how do you manage receivable, if you remember from the book as well, there was a subject, in our slides also, of this working capital management of receivable. We started with assessing the credit worthiness of your customers, and then you manage the receivable by creating and producing by aging reports. Keep a very, how to say, a close monitoring of those customers who are not paying in time, and keeping a strict follow-up, timely follow-up, resolving any disputes with customers. If there are disputes regarding invoicing, documentation, product quality, terms and conditions, those should be addressed in time, so that customers should be able to pay you in time. Then we can say that we can use factoring services. If a company is feeling any difficulty in regarding receivables and liquidity, you can manage your receivables through factoring, in which you transfer your receivable to a factor. And of course it has some cost, because you have to pay some fee to the factor, but definitely you get your cash in advance, and you can use that cash and make some other profits. Fourth option, you can give offering some early settlement discounts. Sometimes businesses, they give some incentive or attraction to their customers to pay early, and they can give the early settlement discount. But before we give early settlement discount, we need to calculate if giving the discount is suitable for us or not. So we calculate the cost of the discount, and we calculate our cost of capital, which we make savings in the interest cost. So if our interest cost savings are more than the discount which we give, we should definitely go for giving the discount. And then you can also speak about that. One more factor you have to think about it. I'm not sure if it is coming to my mind. There are many things, but what we should be speaking, which is, so 4 factors we have counted. There could be a 5th one as well. You can, go through the book, the text, and you can find it. There is something in my mind, but not really significant of writing. So we just said that checking the credit worthiness, assessing the customer credit limits, following up, managing your receivable ledgers and, aging, resolving the disputes, doing the factoring, and giving the discounts, early settlement discounts, and that's all. So, this is a very typical F9 question. We did it together, but it is better that if you do it one time alone on your own as well. When you see something, you get the idea, but unless you do not do it by yourself, it does not, really stays in your mind. You will forget it if you do not do it by yourself.